we've seen that happen over the last few years. Bonds are absolutely not the place to be. It's almost a guaranteed way to lose money, long-term bonds. So if you get this happening in stocks and people are looking for alternatives and they see that you've got these alternative investments that have really been stalwarts and have been pushing higher and higher and higher, and they pay attention because they see, the media starts to pay attention because you have now gold at $3,000, and they say, geez, maybe I should get some gold, but that's kind of rich. $3,000. What else can I buy? The natural alternative is silver. Everyone knows of silver, silver jewelry, silverware, whatever. People know of silver. And let's say gold is $3,000 and silver is $40 or $45 at that point. That's a huge difference for unit cost.
At the end of 2024, the entire investable silver market was worth about $75 billion, a fraction of gold's $3.6 trillion and copper's $600 billion. This relatively small market size makes silver prices extremely responsive to monetary and investment demand changes. With a market size significantly smaller than gold's, silver tends to be more sensitive to supply and demand shifts. From 2008 to 2011, gold gained 166%, but silver skyrocketed by 448%. While gold surged by an incredible 2,328% in the 1970s bull market, silver's price soared even higher, climbing by as much as 4,000%. In this video, prominent investor and writer of The Great Silver Bull Peter Krauth distinguishes silver from other precious metals. He predicts silver will outperform gold in the later stages of a bull market, as seen in the 1970s. According to him, gold's initial dominance as a safe haven asset will shift after hitting $3,000, prompting investors to favor silver as a more affordable alternative. One can't deny that historically, silver tends to experience sharper price spikes and corrections compared to gold. If analysts are correct, 2025 could be an excellent year for silver investors. Silver presents an opportunity for significant returns, with prices potentially reaching $50 per ounce or more. Diversification is key whether you're investing in physical silver bullion, ETFs, or mining stocks. While reflecting on market growth, Krauth also emphasizes the influence of FOMO as rising silver prices attract media and investor attention, leading to a self-reinforcing cycle of higher prices. He notes that while silver's volatility can be intimidating, it offers substantial opportunities for gains, particularly in silver stocks. The silver mining industry has consolidated and rationalized significantly since prices peaked in 2011. The remaining producers have stronger balance sheets and more disciplined management teams and are generating record margins and cash flows at current silver prices. This may make them resilient investment options compared to past cycles. Now we present the clips of Peter Krauth's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
If we just look historically at what has happened in bull markets for precious metals, silver has always outpaced gold in a precious metals bull market. Always. It's always come out with higher gains. It's only that the gains tend to be more back-end loaded. In other words, it will underperform for quite a while, and then in the sort of latter half or latter quarter of that bull market, when you can see that in hindsight, is when it outperforms. And the best example we have of a long-term market like that is the 1970s. Gold was up, I was saying earlier, 14 times. Silver was up 28 times. So it actually doubled gold's returns in that decade. But again, most of that outperformance came at the very end. A couple of reasons for that. I think that more attention is paid to gold. It's the king of many things, king of precious metals, king of safety, king chaos hedge, all of that sort of thing. It's the reference point. So people will simply pay more attention to gold. And if people are not, that maybe big followers of precious metals until we get into these exciting bull markets and they become eventually more aware of them later in the bull market, they look at gold first. They see what gold has done. And gold, let's just make examples, come up with some rough potential ideas here. So let's say gold goes to ultimately, $4,000, even $3,000. I think it's going a lot higher eventually in this cycle, but if it goes to $3,000, that's going to, I think, and that's not very far off right now, but these big round numbers are psychological triggers, I think. And so we're going to see people start to pay attention a lot more to it. And yet they're going to look at gold and say, wow, geez, gold's gone from $250 in 2001. It's more than 10 times now at 3,000. And especially if we see the stock market roll over, let's say tech stocks start to, underperform, broader markets underperform, It's almost absolutely guaranteed bonds are going to be a loser for the next decade. And that continues. We've seen that happen over the last few years. Bonds are absolutely not the place to be. So if you get this happening in stocks and people are looking for alternatives and they see that you've got these alternative investments that have really been stalwarts and have been pushing higher and higher and higher, and they pay attention because they see, the media starts to pay attention because you have now gold at $3,000 and they say, geez, but that's kind of rich, $3,000. What else can I buy? The natural alternative is silver. Everyone knows of silver, silver jewelry, silverware, whatever. And let's say gold is $3,000 and silver is 40 or $45 at that point. That's a huge difference for unit cost, right? And they'll say, wow, maybe I can get a lot more silver for my money for the same. If I'm buying $1,000 worth of metal, I'm getting a lot more silver for my money than I am buying gold. And I think that's kind of what happens. That's the mindset. Then there's FOMO as well. People will see this becomes very exciting. It feeds on itself. And then people will say, geez, silver has gone from $35 and it went to $40 and it only took a few months. And then it went from $40 to $45 and it only took a few more months. And people start to feel like they're missing out on this, and then it really feeds on itself, and then it really pulls silver higher. So silver also tends to be more spiky than gold in bull markets because you get these run-ups and then the corrections. Overall, over a long-term cycle, it does also trend up. If you remove the spikes, it does trend up pretty steadily, and then the big spike comes at the very end. And like I say, that's when it really outperforms gold. So for all these reasons, it's definitely a place to be. I think people are well advised to know and expect that it's going to be volatile. It's going to be more volatile than gold. And if you talk about silver stocks, that's another, it's exponentially more volatile. And yet it's the volatility that brings the opportunity.
Prominent analysts like Peter Krauth focus on silver but see similar trends in gold, noting both metals could be impacted by Trump's tariff discussions without exemptions. Silver prices dropped to around $30 as the US dollar regained strength following escalating tariff threats from US President Donald Trump. Regarding global silver inventories, Krauth underscores significant tightness, with London holding only 50 million ounces available for delivery. Similarly, New York inventories show only 70 million ounces deliverable. However, supply challenges are driving substantial inventory depletion, as reflected in the rapid decline of silver ETF holdings and exchange inventories. Silver inventories on the LBMA and COMEX fell by 50% over 2023 and 2024 to 321 million ounces, the lowest levels since 2010. Without material supply growth, these inventory buffers that have bridged the supply-demand gap may soon be exhausted, forcing the physical market into backwardation and pushing prices higher. In China, silver premiums surged to 10%, reflecting strong demand, particularly for solar panel production. Krauth emphasizes China's urgency, with buyers paying above spot prices and in advance to secure supply. Let's get back to the interview.
My focus is silver, and from what I've seen, there are very similar things happening in gold as well, because essentially, the impact would be about the same. And so what we've seen is that for the last couple of months, so once Trump started talking about these tariffs, and there was never a mention of any kind of, potentially excluding things like gold or silver, for example, since that's what we're talking about, that these metals would be affected by that. First top line is that London's total silver in inventory is about 825 million ounces.
Mm-hmm.
These black bars are what silver ETFs hold. So that's about 525 out of the 825. So about 60%. The green part is actually what's left over. So what we call the free float. However, what needs to be available for daily trading, because these metals move around and so on, you need this liquidity, actually is 250 million ounces out of the 300 million ounces. That leaves just 50 million ounces if deliveries are required. That's historically very low. I'm going to show you another chart that is New York. Now, it's similar, but there's less total ounces because, like I was saying earlier, more of the ounces are held in London for whatever reason. So we're talking about 300 million ounces in New York total inventory.
Mm-hmm.
And these inventories are split into what we call registered or eligible. So it's only the registered portion of the inventories that are available for delivery. And if you do the math, it's about 23%. And that works out to about 70 million ounces. So if you have a scrambling to get physical metal, because again, you've got this concern about having to get your metal from outside of the US, then people are going to scramble for what's currently available. And I'm going to show you a couple of other charts. This is COMEX silver inventories. So we've seen in the last, like I said, since December, we've seen this trend up very quickly, so that this suggests very strongly that metal has been coming from elsewhere and being accumulated in New York. And if you look at this chart, which shows delivery, so this is metal that's in New York, but being taken in physical delivery. So it's actually coming out of the exchange, and it could be anyone. It's usually large banks or whoever, but that are saying, okay, it's fine that I have a claim to this metal on the exchange. I want the actual metal, and I'm going to stick it in my own storage vault. And so this spike, which was at the end of last month, shows that that's exactly what's going on. That not only are the inventories in New York growing, but despite those inventories growing, or the metals growing in inventory, but it's also eventually coming out of that inventory because people want to have control of the physical metal, and these are the deliveries in New York. So we have something a little bit similar in Shanghai. I think they're concerned about the trade tariffs as well. We're seeing their inventories spike up, and here's proof of what you were asking about earlier in terms of the prices. So the bottom part of this chart, it has been a little bit higher for some different reasons. I think, market tightness and production in China, especially of things like solar panels. But in the last few months of 2024, the premiums actually rose again to just under 10%. So in China, they're paying 10% over what is being paid in the US for an ounce of silver, just because they are so anxious to get their hands on it. And if you look back about a year, there was a president of a larger silver producer that told me that they sell about half their production to China, about half of it to the US or to the West. And they said that they see just how tight inventories are. He said the Chinese are coming to them and they're saying they're willing to pay 2 weeks in advance of delivery. And
Wow.
they're willing to pay a few dollars above spot price because they need that silver so badly. Most of it is to manufacture solar panels, which have become about 20% of all silver consumption today. So solar has really become strategic in that sense, in terms of silver.
Silver's future performance will largely depend on its industrial demand. Silver could see increased demand and higher prices as technology advances and the demand for electronics and renewable energy sources grows. The outlook for silver in 2025 appears bullish, with most predictions indicating significant potential for price appreciation. Given these trends, how do you think the current challenges will influence silver's short and long-term price movements? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.